Hey everyone, welcome back to the Finance Things in Life. I am Matt Pitti, along with my brother Anthony. We're from the Pitti Group Wealth Management. And today we are going to be talking about the top 5 financial mistakes you can make. And this is according to Finance Times.
Okay.
So we're doing a list. Anthony, I have the list. Anthony does not have the list. He is going to try to guess. I'm going to give him a little bit of a hint, just to kind of make it interesting.
Hopefully not too much of a hint.
No, not too much of a hint.
Keep it interesting.
Yeah. I don't want to give it away.
No.
Then we can kind of see how close he can get to the answer, and then we'll go from there as far as maybe explaining it a little bit more. You ready for this?
Ready as I'll ever be.
All right.
Give it a shot.
Okay.
If I mess up really bad, we'll just edit that part.
There we go. No, we should just do this live.
This is live. I'm going to do it live.
All right. So like I said, top 5 investment mistakes to avoid in 2025.
In 2025.
Here we go.
This.
All right. Number 1, NFTs. Non-fungible token, whatever it stands for.
5 mistakes. I will say...
Now that I think about it, might not be a good enough hint, but let's see what you can do.
I will say investing in viral trends.
Close. Yeah. I'll give that to you.
Okay.
So chasing trends without research.
Participation reward.
Yeah. So chasing trends without research.
Okay. Yeah. Yeah, it's a big one.
Yeah.
Riding that roller coaster, trying to catch the upside.
Right. Whether it's, NFTs or crypto
meme
or
stock.
Meme stocks. That is a big one, which happens more than you think.
Yeah, NFTs. Do you remember you were buying a picture of a monkey, and they're like wearing different things, and these were selling for like $5 million.
Oh yeah, I mean
they're worth like $45 now.
Right. I mean, these people invested millions of dollars into these NFTs, and now they're worthless.
Yeah. Yeah, this is when the metaverse was coming out.
Yep.
People were buying property in the metaverse. I think Snoop Dogg had like a $20 million property in the metaverse. Right. And then people were saying they were going to essentially put these NFTs inside their virtual mansions. And then you could buy like virtual sneakers and virtual clothes. And like, I don't know how much that's worth now, but I can't imagine much.
Yeah, I can't imagine either. But yeah, I mean, and it was the trend. It was the thing to do. It was the cool thing. Now that we sound like boomers saying that.
I know, right? But, these youngins.
Right. But no, I mean, everyone thought that was the thing to invest in, that they were going to make money. And, I mean, unfortunately, most people probably bought in at the top if they did buy those. And like I said, now they're worthless or practically worthless. So
yeah. Yeah, that's a big one. I mean, even on a more, I guess, realistic scale, like obviously we're not Snoop Dogg buying property in the metaverse, but even the meme stocks, like if you look at GameStop, people that were buying, I mean, we know people that were buying GameStop at its very high. I'm not sure what it's trading at now, but I can imagine it's nowhere near. I think it was like around like, I don't know, in the hundreds of dollars a share.
yeah.
And that just made no sense to me. Like, GameStop, you could walk through the mall and see an empty GameStop. I just didn't understand it.
Yeah. Well, I mean, I don't think their financials made.
No, it was because of the short positions.
Yeah.
But still, like, I mean, if you're buying an investment to try to, capture a trend on the upside, that's a very risky position to be taking because the potential downside is substantial.
Yep.
You're not buying it because of their books or their future growth or anything like that.
Most people aren't looking into that. Most people aren't doing the research.
Right.
You know what most people are? They're FOMO.
Yeah. Yeah. And you want something to talk about.
Right.
Yeah. When you're having a conversation with your friends, be like, yeah, I bought GameStop.
Right.
You don't tell them at the price that you bought it.
Well, no. I mean, a lot of times it's, your friend says, hey, I made a ton of money on GameStop. And you're like, oh, shit, I got to go buy a GameStop because you don't want to miss out.
Right.
So you hear about it on the news or whatever, social media, and it's just this FOMO that everyone has, and everyone just wants to pile in because everyone wants to be a part of it.
Yeah.
So,
yeah, that's a big one. Do your research. make sure you're not making a huge financial mistake by purchasing something just because other people are talking about it.
Yeah. Okay, you ready?
That was fun. All right, so technically 1 for 1.
1 for 1. I'll give you that first one. Okay, number 2, eggs.
Eggs.
I'll even give you like a second part.
Okay.
I don't know if it'll help or make it worse.
I instantly go to billions.
Right. Easter. Eggs, Easter, like what do you think?
Eggs and Easter. Finding Easter eggs, like finding no, that wouldn't be a mistake. I have no idea. I'm gonna go. I'm just gonna avoid this one.
All right. So the saying I was trying to get you to think about is all your eggs in one basket.
Oh, touche.
All right.
That's a fair hint. I was not thinking anywhere near that.
All right. So the second one's ignoring diversification.
Oh yeah, that's huge. Yeah.
Right? Yeah. I mean, you can't put all your investments or all your assets into one particular investment. Because if you make the wrong decision, and sometimes it can come out of the blue. What happens to a stock or investment?
Mm-hmm.
You could lose everything. It could be detrimental to your portfolio. So diversifying is, kind of what you learn first as an advisor. Diversifying your portfolio, having a bunch of different investments. So that would be the second one.
Yeah. I mean, the general idea there, like, I know it's difficult because you may be buying Nvidia, which has done fantastic over the last few years, but there could come a day where Nvidia has a bad quarter, a bad year, whatever it might be. It's happened. We've seen it historically. But if you're not diversified, the idea is if that investment goes down, you have other investments to boost up your portfolio. So you may not be getting Nvidia earnings every day, month, quarter, year, but you've got a little bit of security, a little bit of peace of mind that if Nvidia drops 10%, your entire account value isn't down 10%, especially if you're getting close to retirement or you're going to be living off of some of those assets or need some of those assets. That's something that you need to be incorporated into your portfolios.
And it's not just a mix of stocks and bonds. It's diversifying your bond portfolio, diversifying your stocks.
Mm-hmm.
You have small caps, you have mid caps, large caps, you have international. Not
all tech,
real estate
investments, real estate,
international. So
yeah, I mean the gamut of diversification
right.
is quite large.
Yeah. So diversification is number 2.
All right.
Or ignoring diversification would be number 2.
All right, so 50%.
All right, here we go.
Number
3. Let's do...
Brought to you by the Pitti Group Wealth Management.
I like that. Stopwatch.
A stopwatch?
Yeah.
Gosh. A stopwatch. Timing the market.
Perfect.
Hey. That's a great one.
Yeah.
It kind of loops back into some of the stuff that we've talked about, especially with like the meme craze. People trying to time the market. You especially with like social media. I follow a lot of like finance stuff, and you'll see a lot of influencers that are day traders,
right?
Trying to time the market, saying they've made, I've made $1 million in my portfolio this week, and this is how I did it. Yeah, timing the market is like the end all be all. Do not do it.
Right. I'm not going to say you can't do it because every once in a while, what is this? A blind squirrel finds a nut, right?
Mm-hmm.
You may time it, once, twice, but you're not going to be able to consistently time the market. It's just not going to happen.
Yeah.
So, it's more of, what we always say, investing is like a marathon. It's not a sprint.
Mm-hmm.
You got to invest for the long term. Trying to time it and you think something's going to happen and it's not, it could kind of, decimate your portfolio.
Yeah.
If you get it completely wrong. Then add on top of that, you're not diversified. Then
Good Lord.
Right.
Yeah, I mean, look at it back in the spring when we had that market correction and the markets were down. I don't know what % they were down. But some people wanted to move their investments to cash. They were worried about the markets. and you go from the lowest of lows, and then literally a day later, we had one of the best days of the market since, what was it, World War II?
Yeah.
And if you moved the cash, you're not buying the day before that. Like, there's no way. You're not seeing that trend because it happens. So then you have the best day in the market since World War II, and then you decide to put your money back to work. Well, you've just missed all of that.
Right. All that upside.
Yeah.
Yeah, it's just not, it's just not practical to try to time the market. Now, there's ways to kind of, protect yourself. One that starts with diversification, but, you can kind of protect yourself and maybe do things here and there, but trying to time it, getting in and out is just,
or
not.
You just go into dollar cost average.
Yeah.
Just DCA over a certain amount of time. You could put a certain amount of money to work every month. You have a certain amount of money set aside in cash, and then if you have a big downturn in the market, put the rest of it to work. Go from there.
Yeah.
Yeah, there are definitely strategies, but timing the market is not one of them that I would rely on.
Right. I agree.
All right, so not bad. Two out of three.
Okay. I'm going to give you an easy hint here.
Oh, boy. Hopefully I get it.
So
I feel like you don't want to make it that easy.
I don't want to make it that easy. It's like.
Except brotherly love.
Right.
I'm not going to make it easy on you.
No, I don't. I mean, I don't want to see you fail, but I don't want to, like, also.
I don't want to see you succeed either.
Right. No, I want to see you succeed, but not where I don't want to hand it to you.
Right. We don't do the participation rewards here.
Right. This is certain in life.
Death, taxes. It has to do with taxes. You smiled.
I gave it away.
Not being like tax efficient.
Close. Overlooking fees and taxes.
Ooh, that's a good one.
Yeah.
All right.
Yeah. I was gonna say, I could say just death, and then he would say and taxes.
Well, I was thinking from our earlier podcast that tax is going to be more certain than death
right.
soon. So.
Right. So overlooking fees and taxes, and I think that's a huge one. A lot of times when we're meeting with prospects, they don't even know what fees they're paying on their investments.
Mm-hmm.
And then also, they're not thinking, how can I be more tax efficient? Whether it's investing in a Roth IRA instead of a traditional IRA, whether it's, capital gains and possibly taking, selling something and paying capital gains, and let's say they sell it in December. Well, you could take half that position and sell it the next month and kind of split your capital gains there.
Right.
So I think that's a big one. Fees and taxes.
Yeah. I always get a shocked face whenever I'm talking to prospects about what fees they're paying on their portfolios, especially depending on the source of their investment. Like if it's a 403b, there seems to be a decent amount of fees with those. Yeah, that's always a tough conversation to have. You're like, do you know what's coming out of this account? It's like, well, got a general idea. And once you break it all down, it's like,
yeah, whether take distributions from certain accounts, and man, it can add up, taxes, fees, and yeah.
Yeah, I mean, especially like even taking an early withdrawal from an IRA, and you're getting a 10% penalty, and then paying taxes on top of that. I mean, that can, depending on how much money it is, that can hurt.
Yeah, I've seen a lot. We've talked about it before too. Is 403bs. Those retirement plans. Some of those providers have significantly higher fees than other providers, and and it's hard to miss. Or it's easy to miss.
Easy to miss.
I knew. Hard to find. Hard to find. Easy to miss. And that's, you really need to be looking for that, or have advisor take a look at that and kind of walk you through those fees.
Right. If you look at the course of your career, I mean, if you're paying those fees over the course of your career, that's a pretty hefty payment to make. It can really inhibit your potential growth in that account.
Mm-hmm.
Yeah, definitely. If you don't know, ask the question.
Right. Oh yeah, and it doesn't.
It's easy as that.
it doesn't hurt to ask. I mean, that's what,
You don't know what you don't know.
we're there for. There's the line. All right.
I feel like that should be the name of this podcast.
We're going to change it?
Yeah.
All right. Last one. What have you got?
Drum roll.
You got 3 out of 4?
Yeah.
All right. I'll give you 3 out of 4. They've been layups for you.
Yeah.
All right, here we go.
Fair enough.
Last one.
Yeah.
Therapy. Kind of relates to
Relying on emotion. Like I'm making emotional decisions.
There you go.
Hey.
Yes.
Woo.
I will give it to you. Well, I mean, you'll believe it, but I mean, how many times have you been called a therapist from a client?
Oh,
You know,
yeah.
like,
All the time.
especially when the markets are volatile and they're calling in, and basically it's just a therapy session. I just want to hear it from you.
Right,
I know what you're gonna say. I know what I need to
Right.
do, but
So many times. I know what you're going to say. I just want to hear you say
right,
it.
I just need to hear it from you. I know I need to stay invested. I know I'm already diversified, but I
Yeah.
just want to hear it.
Yep. 100%.
Yeah.
That's such a big part of it. Yeah. I mean, there's so much of this job that is very much like therapy. Being in this business, you get I don't want to say like a numbness to what the markets are doing or the news, but you kind of see it more of a,
Accustomed to it, or
I don't say accustomed to it, but the word's not hitting me, but on a non-emotional level, just looking at it as for what it is.
right?
Um,
Well, that's our job. Our
Right.
job as an advisor is to stop you from making emotional decisions when it comes to investing.
right.
Because, when you make those emotional decisions, you're often going to make a decision that is not in your best interest.
Right. Yeah. Like anything. I mean, you can look back at most of your emotional decisions and say, probably wasn't ideal.
Right. Well, I mean, how many times, what do they say? Like, you get that nasty email from someone,
Oh, yeah.
right? And you're ready to go.
Mm-hmm.
You're all fired up. You're typing it out.
You write that
Yeah,
first
right.
email. The best thing to do, delete
Is-
that email,
Delete it.
write it again.
Take a night,
Yeah.
and then come back the next day.
Sleep
and write
on it.
Sleep on it, right? Because emotionally, you're not thinking clearly.
Yeah.
You're just gonna make a bad decision. I mean, it's just inevitable. you
Yeah.
know, and
Yeah, and I mean, at the end of the day, when we're creating these plans, or whenever an advisor's creating your retirement plan, we're not looking at your plan like if it's all sunshine and rainbows. Like, this is markets are going to be up 15% year over year, and you're going to have a successful retirement plan. We're thinking about those down years as well. So when you have those down years in the market, when things aren't great, we're making sure that your plan is still healthy.
right.
So we don't have to react emotionally when that happens, because we've already planned for that. We've already taken into account that can happen.
Yeah. I would say 5B would instead of the letting emotions is a financial plan. Not having a financial plan is another big one.
Yeah.
Because having that financial plan, like you said, is going to help you avoid making those emotional decisions.
Yeah. Yeah. I mean, I was just meeting with someone last week, and we were discussing their retirement. They had a decent amount of assets saved up. They'd done a great job investing. And it's like, well, what's your plan? I'm like, well, what do you mean? It's like, well, you've got all of this. What do you want to do with it? Like, are you close to your plan or not? Are you close to a successful plan or not? And they have no idea.
Right.
And it's like, well, let's create something, and let's see if what we have is enough. And if it is, fantastic. If it's not, then let's incorporate this to get to that point.
Right.
But yeah, if you don't have a plan, you're just running.
Right.
You're just
Well,
running without
you're right.
an ending.
And that's what's going to lead you to making
Like
those emotional
Forrest Gump.
decisions. Right.
Just
Just
running.
Run, Forrest. But yeah, and it's completely normal. I don't want people to think that it's abnormal to make emotional decisions.
No, I mean, that's
Um,
the human nature.
But I think having that plan and having an advisor to help walk you through it and help you make those decisions and kind of
hold your hand through it. Yeah, nothing wrong with that.
Therapy.
Yeah.
Financial therapy.
Exactly.
I mean, that's a
financial therapist.
Yeah, financial therapist.
It's like being a bartender. Same thing.
Yeah.
Just different therapy.
Right.
When I was bartending, it was therapy all the time. People come in, just start talking, and you just listen.
Yeah.
And said, I offer you a beer, now I offer you financial advice.
Same thing.
Both make you feel better.
Right. All right. Well done. I'll give you 80%, 4 out of 5 passing grade.
I'll take it. I'll take it and run.
All right. But yeah, I appreciate you guys tuning in, or we appreciate you guys tuning in. You know, kind of top 5 things to avoid in 2025. Hopefully you can kind of take something out of it and learn something. And if you are doing any one of those and you want a second opinion or you want some guidance, you know, feel free to reach out. And
we are available.
We are available for you.
Be your therapist.
Yeah.
We'll even bring out the couch for you.
Taking new clients. All right. Well, thanks again as always.
Yeah, thank you.
Yeah, I'm sure we'll talk soon.
Take care.